Sydney and Melbourne both went negative in December for the first time since January last year. At exactly the same time, three major Australian banks just flipped their forecasts. Now they're expecting interest rate hikes in February and May. Not the rate cuts everyone was hoping for. And the first home buyer scheme has split the market so dramatically that properties under the price caps are appreciating at nearly double the rate of properties above them. Here's what's actually happening in Australian property right now. So let's run through what's happening in Australian property markets over the past couple of weeks, because there are three significant developments happening right now. First, Sydney and Melbourne both recorded month-on-month price declines in December. Sydney is down 0.1%. Melbourne is down 0.1% as well. That's the first time either city has moved backwards since January 2025. The national picture is different. Cotality's Home Value Index shows the national market rose 0.7% in December, which is a solid gain, but it's the smallest monthly increase in 5 months. Regional markets performed better, up at 1%. So what's driving this? The data points to two things. Okay. First, properties above the first home buyer scheme price caps are softening. This segment includes much of the upper quartile stock in Sydney and Melbourne that had appreciated substantially through 2024 and 2025. Second, there's been a moderation in growth momentum after the explosive early weeks of the first home buyer scheme expansion. From October to November, monthly growth nationally was running at 1.4% as buyers rushed to use the new scheme. By December, that moderated to 1%. Still solid growth, but not the unsustainable pace. Cotality's director, Tim Lawless, said that December's marked a moderation in the pace of price growth from the exceptional rates seen in late October and November, following the expanded first home buyer scheme launch. This is a normalization from an ordinary pace, not a crash. The bigger story is what happened with interest rate expectations. 2 months ago, the consensus forecast was that the RBA would cut rates multiple times in 2026. Now, that's completely reversed. Commonwealth Bank released a note in December saying that they now expect the RBA to raise the cash rate by 25 basis points in February 2026. That's a full reversal from earlier rate cut expectations. NAB forecasted 2 rate hikes, February and May 2026, totaling 50 basis points. That would take the cash rate from 3.6% to 4.1%. UBS is also calling for 2 rate hikes in 2026, with rates potentially reaching 4.85% if the RBA moves more aggressively. Westpac, however, is outlier here. They forecast rates to remain on hold through all of 2026, but they acknowledge the risk of an earlier hike. So why the reversal? Inflation didn't fall as expected. Headline CPI came in at 3.8%, above the RBA's 2 to 3% target band. Trimmed mean inflation, the RBA's preferred measure, is at 3.3%. The RBA's December statement said inflation had picked up more recently and noted that they would be more attentive to incoming data. In central bank language, that means the cutting cycle is over and tightening is now being considered. The expanded first home buyer guarantee scheme launched 1st of October, which removed income caps and lending limits. It created a distinct market split. Properties below the scheme price caps are appreciating at nearly double the rate of properties above the caps. In the December quarter of 2025, properties under the first home buyer caps went up 3.6%. Properties above the caps were up 2.4%. In Sydney specifically, which has the highest price caps, below the cap grew 2.3%, but above the cap, they actually fell by 0.1%. And looking at December's monthly data, below the cap grew by 1%, anything above the cap only grew by 0.5%. Over 21,000 first home buyers have used the expanded scheme since October. That concentration of demand is creating this two-tier market structure. Cotality's data shows that lower quartile values increased by 1.1% in December, while upper quartile values increased at just 0.2%. The entire market's growth is weighted towards the affordable segment. While first home buyers are driving demand in the lower cap segment, investors are also returning to the market in force. In the third quarter of 2025, investors accounted for 41% of mortgage demand, the highest share since December 2015. That's a decade record here. Investment credit growth is rising at the fastest rates since December 2015. And the driver? Rental yields remain firm. Rents are up 5 to 6% annually across Australia. And those rent growth rates combined with 3.6% interest rates, cash on cash returns are really attractive, particularly in the lower price segment where gross rental yields run the highest. The national vacancy rate sits at 1.3%. That's up from 1.2% in the month before. So technically easing, but it remains extraordinarily tight by historical standards. If we look at it by city, Sydney is at 1.4%, Melbourne at 2%, Brisbane 0.8%, Adelaide 0.5%, and Perth 0.4%. Nationally, combined rents, so houses and units, are up 5.3% over the past year. House rents are up 5.1%, unit rents are up 5.6%. Sydney specifically, rents up 6.3% annually. Rental demand remains very strong. Vacancy risk for landlords remains minimal. So here are some 2026 price forecasts. Property analysts expect growth to continue in 2026, but at a moderated pace compared to 2025. 2025 saw approximately 8.5% national growth. For 2026, forecasts range anywhere from 5 to 7% nationally. Right? That's according to AMP, or 6 to 8% according to Domain. However, these are weighted averages across all price points. The actual picture is likely to be two different growth trajectories. Lower price segments, so under the first home buyer caps, expected to show stronger growth in the first half as the scheme demand pulls through. At the upper price segment, so above the first home buyer price caps, is expected to see moderated growth if the rate hikes materialize. Regional markets are showing more resilience than capital cities based on current trends. So what is the data showing right now? So here are the patterns that's emerging. Okay, so rate hike expectations are now the consensus view. This is a fundamental shift from the rate cut consensus just 2 months ago. Sydney and Melbourne are cooling, specifically in the upper price segment where affordability is already stretched. The first home buyer scheme is creating explosive demand in the affordable segment. Lower priced properties are appreciating at nearly double the rate of higher priced properties. Investor demand has returned to decade high levels, competing with first home buyers in the lower price segment. Rents remain solid, up 5.6% annually. Vacancy rates slightly easing, but still historically tight. Monthly growth momentum has moderated, but remains positive. Down from 1.4% in October, November to 1% in December, but still above historical averages. If you found this market update useful, like the video. It helps surface this data to more viewers who need to understand what's happening in the Australian property market right now. Leave a comment with what you're observing in your local market. Are you noticing the below cap versus above cap divergence in your area? Are you seeing investor activity pick up as well? And subscribe for weekly updates on Australian property market data. And if you're trying to understand how these market shifts affect your situation, whether you're looking at property, thinking about investment, or tracking what's happening in your suburb, book a strategy call with the Investor team. We break down the market data weekly and can walk you through how these changes affect you specifically. Link is in the description below. Thank you for watching.